All right, let's dive in. Today, we're going to pull back the curtain on a part of the financial world that's quietly changing how people think about long-term investments. We're talking about the secondary market, a place that's creating real opportunity where, frankly, there wasn't any before. So let's start with a problem that you might find a little too familiar. I mean, really think about that. We're also used to stocks and bonds, right? You can sell them with just a click of a button. But what do you do when your money is tied up in something like a private company or a real estate fund for, say, 10 years? How do you get out if you suddenly need to? And that right there, that's the core of what's known as the liquidity dilemma. Alternative assets, things like private equity or venture capital, they can be incredibly valuable, for sure, but they are notoriously illiquid. You can't just decide to cash out whenever you feel like it. And this is where our whole topic for today comes into play. The secondary market is the elegant solution to this very problem. It's a specialized marketplace that was built for one reason: to let investors trade these otherwise locked-up assets. It's a crucial path to getting your cash back. Now, to really get what this market is all about, it helps a ton to compare it to its much more famous sibling, the primary market. Once you understand the difference between these two, everything else just kind of falls into place. And there's a perfect analogy for this that really makes it all click. Okay, think of it like this. The primary market is the first sale. It's a brand new company selling shares to investors for the very first time. The secondary market, well, that's the resale market. It's everything that happens after that first sale, where those very same investment stakes get bought and sold between different investors down the line. So who exactly is trading in this market? I'll tell you, it's not your average day trader. Let's take a look at the key players, and more importantly, what's driving them to make these deals. On the selling side, you've usually got someone called a limited partner, or just LP for short. That's really just the official term for an investor in one of these private funds. They're the ones who put their money in at the beginning and are now looking for a way out. And here's where it gets really interesting, because their reasons for being in the market couldn't be more different. The sellers, our LPs, they're often looking for a solution to an immediate problem. Maybe they have a sudden need for cash, or they need to rebalance their overall portfolio. The buyers, on the other hand, they're playing a completely different game. They aren't just there to provide a cash-out option, they are strategically hunting for some very specific advantages. So what are those advantages? Well, for one, buyers get to skip the riskiest, earliest years of a fund's life, that initial period of losses known as the J-curve. They also get amazing visibility. I mean, unlike investing in a brand new fund, which is basically a blind pool of money, they can look under the hood and see exactly what assets they're buying. And the biggest prize of all, they can often buy these mature assets at a discount to what they're actually worth. It's kind of like buying $1 for 90 cents. Okay, so we've got the who and the why. But what about the how? How do these deals actually happen? This isn't like logging into your E-Trade account. These are complex, private negotiations. Generally, these complicated deals fall into one of three main buckets, and it all depends on who's kicking off the sale. Is it an individual investor? Is it the fund manager? Or is it a direct sale of a piece of a single company? Let's break down the two most common ones. This lays out the two main paths perfectly. An LP-led deal is that classic scenario we've been talking about. One single investor needs out and sells their personal stake. But a GP-led deal? Whoa, that's a totally different animal. This is started by the fund manager, the general partner, or GP, the person who actually runs the fund. This is usually part of a major restructuring, where they might move their best assets into a new fund and give all the investors a choice. You can either cash out now, or you can roll your investment over and come along for the ride. So let's just zoom out for a second here. Beyond all the mechanics of how the deals work, what's the big picture impact of this market? Why has it become so important? At the end of the day, it all boils down to two huge game-changing forces. First, it injects liquidity, turning a rigid, locked-down asset into something you can actually trade. And that in turn creates incredible flexibility, which lets investors actively manage their portfolios instead of just passively sitting on their hands for a decade. So here's the bottom line, the key takeaway from all this. The secondary market has totally transformed alternative investing. It provides a vital escape hatch for investors who need one, and it lets these massive institutions manage their portfolios in a much more dynamic way. It's a true game changer. And that really leaves us with one final, pretty big question for the future. As alternative assets keep getting bigger and becoming a larger part of the investment landscape, it feels like the secondary market is going to go from being just a niche solution to an absolutely essential tool. So the real question is, how long until it's considered a standard part of every single major investor's playbook?